Okay. Let's give it a minute, get a few people in here. Happy holidays. All right. Let's get a few more people in here. This looks a little bright. Let's try and shut some of these lights off here. That's a little bit better. Maybe still better. Let's see. Yeah, there we go. Happy holidays. Merry Christmas. All right, so you guys know the drill. While we're waiting for some more people to come in here, give me some of the stuff you want me to talk about, and I'll try and cover it in the video. Ho, ho, ho. So let's see some let's see, Amazon, Baba. Nothing else? Usually you guys have more stuff you want to talk about. Disney, GS, Wells Fargo. Keep going. Yeah, we'll cover Chipotle for sure. Twitter. Okay. All right, I think I have a good amount of stuff from you guys here for the moment. All right, so let's begin. Anyway, for those of you who don't know, I'm Justin Pulitzer. I have a Twitter stream, a YouTube channel, and obviously Periscope. And I often do broadcasts with my views on the stock market, the major market indices, as well as momentum stocks. If you happen to be watching this for the first time, enjoy. Be sure to follow me, and you will get notifications when I do new videos. I also, if you happen to catch this late, or if you want to see it again, I encourage you to watch my YouTube channel, which is Justin Pulitzer Trades. I also, for people who are new, I have a new Instagram account where I do these great little 15-second videos every morning talking about what the market is keying off of for that day. If you're not following that, that's Justin Pulitzer Trades as well. Just search it on Instagram. Anyhow, let's get started. So, happy holidays, Merry Christmas to you as well. So let's rock and roll here. So we know we had the Fed decision last week, and I think initially it was viewed as kind of a, I guess I heard a lot of the TV talking heads saying it was a dovish hike. And I guess I could agree with that categorization in the sense that they're still doing the reinvestments, the runoff of their bond portfolio. They are reinvesting. I've dubbed that term QE light. So I had said that it's sort of like the Fed trying to raise rates now without stopping their asset purchases is like trying to step on the gas and also having one foot on the brake at the same time. So you get a lot of wheels spinning and not all that much happens. So they were correct in that sense, but the bigger issue that I see, and the one I've been championing, and the one that I think that people have missed, is that it's not so much that how much they hiked, or when they hiked, or what their path, their glide path is to higher. They've already signaled that. We knew this summer that they're going to normalize at only 3.5%, which is lower than the normal 5 to 6%. The issue is that they raised rates into a slowdown. I view it as a policy error. This was one of my biggest fears for the stock market and the economy, because we all know that things have been slowing in the economy. And I've devised a list, and I have my 6 market keys and I have my 6 Fed keys. And I believe that those are going to be the keys for the going forward. And I've marked those off, the 6 Fed keys being the jobs as in the non-farm payrolls, The GDP as measured by, I use the Atlanta Fed. I also look at the ISM, both the manufacturing and the service sector. The service sector being, I think, at this point, the more important of the two. Of course, PMI, durable goods orders. We got a reading today. It was quote-unquote bullish because they were expecting a larger contraction than we had, and it was actually flat from the last read. The only problem is that the last read was crap. Sorry to say it, but it's true. The last read was rather weak. It's been buoyed by strong, I guess, housing, which has been kind of strong, and we've also been buoyed by, I guess, strong aerospace numbers. They're selling a lot of people say it's like kind of like a read into how Boeing is doing, as well as autos. Now, one of the things the Fed had cited was housing and autos as being strong. The only problem is they need, those two particularly require interest rates to stay low with regard to financing. If rates start going up, and they now are, it's trouble for the two sectors that are kind of the engines of the economy. We know the dollar is important. That has backed off a lot. That is very good. That is also one of my biggest fears for the economy. If the dollar starts really ramping, it makes U.S. goods in foreign markets. We already have a trade deficit, and with regard to how much we import and export, and a strong dollar is like pouring fuel on the fire for that. I've also said that the other and the seventh unofficial key for the Fed is the S&P 500. I think that they got spooked with the big 1,400 down point move, but the market quickly recovered, and that, I guess, gave them some cover to raise. So that's where we stand. The Fed has now hiked interest rates into a slowing U.S. and global economy. As I've discussed ad infinitum, oil is being used by traders as a proxy for global growth. The algorithms at extremes, usually at the lows and at the tops, key into oil, meaning if we're up a lot, like if oil is at the top of the range and oil keeps going, the more it goes up, the further the market drops. The inverse is the truth down here now that we're worried about recession, that the lower oil goes, the more the market drops, and when it rallies, the market can rally. So today I had said we were in day 3 of we could either do it this way, the American way, or we could do it this way, the German way, however you want to do it. We were in day 3 of the oil rally, and that gave cover for the market to rise. We had inventories that came out at 10:30. I had cited that as being important. And the key with regard to that was they had a drawdown. They were expecting a build, so it was a very bullish number with regard to the oil. So that further elevated the price of oil. That rallied this big stocks in the Dow, like the Exxons, also in the S&P, the Exxons, the Chevrons. I mean, you name it. Those stocks which have been kind of beaten up had pretty nice rallies. With regard to Exxon, I do have a small long on in that for a right or right out play. What I liked about that chart today was this. A few days ago, you had come down, I believe this was on 12.8, and then you had a higher low off of the 61.8 on 12.14. I had been playing it short with put ratios. I covered them there, and I actually was net long there. I had taken that off, and I kind of re-upped it today. Sorry about that beeping. I have a appliance that's giving me trouble here. Anyway, so they held the 61.8 of the recent move from the 66.55 low to the 87.44 high. I will discuss this in much more detail in my weekend review video, which is out on Sunday. But for now, the thing that was key to me about today's move was it broke the down channel. And today's move took out 5 days worth of trade. And not only that, but it put in a higher swing low, and today's high took out the last swing high. So you had a channel break, or whatever, a downtrend break, and you took out 5 days worth of trading, and you made a new swing high from a higher low. That is good. what I liked also about oil, and I've been discussing this, is that I've been in the camp that I believe oil is trying to bottom. I know that's a little bit controversial. Everyone's very bearish, but everyone is always too bearish at the bottom and always too bullish at the top. I said that I thought somewhere between 37 and 33.20 was going to be the low. It looks like 34.55 was the low. We are right on a like tertiary downtrend line here, so the bulls aren't out of the woods yet, but the good news is that they have a higher low potentially in place here. They're back over 37, which is really key. I mean, I've been saying that, if they can get it back over 37 to 37.75, they start to neutralize a bit and probably can have a run up to 40, which would be good. You really, really need to see oil get back into like that $45 to $50 range. That's really where some of these companies don't have to worry about their debt issues. That's really what's been weighing on the psyche and also on these indices in these markets. That the debt, the fear is that these companies aren't going to be able to make the debt, and that they've been cutting dividends. KMI was sort of the poster child for that. They cut their dividend by 75%, and that has been weighing on a lot of these other stocks. If you're looking for yield, the CEO of Chevron, who might be my new bromance, came out and said their number one priority was to maintain the dividend. What that means, to decode, is that they will fire people and that they will stop exploration CapEx before they cut the dividend. So they are not cutting that dividend anytime soon. You'll first see the layoffs and you'll first see the reductions, although you've already started seeing that. I would say it has not been said by Exxon, but I would imagine that they are the same way. Exxon has an impenetrable balance sheet. They have been becoming... it's just one of the great companies and the great story of the United States. They are a phenomenal company. They have a lower PE multiple. I think that Exxon is sort of one of the ways to play it if you want to play like kind of Chicken Little, which I think you kind of have to be in this market. I think we could also, it has I don't know if it's implied or unimplied, but Warren Buffett had gotten involved in Exxon, I believe, around these levels. He sold up near the highs, which was, of course, Buffett, the best. Maybe he'll want to get back involved at some point. The thing has come down a lot. So that wouldn't shock me, and if that happens, we're going to be off to the races. Chevron, the same kind of thing. They are, I would say, like I said, they're not as good as Exxon, but they are good enough. So that's the deal with those, that I believe their dividends are kind of going to be the safest of the pack. Getting into what you guys had mentioned you want to talk about, I see a lot of mention on here of the FANG stock, so to speak. I think FANG is sort of a victim of its own success here, which is a little bit nerve-wracking because you sort of have the quote-unquote trash leading the market higher, and the best part, the FANG stocks, have been kind of weak and sitting out. I think that they are a victim, like I said, of their success, and I think that they're getting lock-in. Funds are locking those gains in so that they can pay themselves bonuses. So I'm hard-pressed to think that these stocks are just going to rip again for the next year. That's sort of not how the market works. We could run through them really quickly here. Let's start off with, we'll just go through it as FANG with Facebook. Facebook, I took a lot of heat on the stream for this. People, when I liked Facebook when it was down a lot, I've been a bull on. I hated Facebook's IPO when they came out at 38, and at about 20 bucks I turned. It got to 19, and I've really never looked back. I've been bullish on the stock ever since. I've been saying the stock was going to go to 100. I have taken so much criticism over the last 2 years, really almost over the last 3 years for that. And all of the people who insulted me and called me a moron and various other names, I have yet to get one apology. Not only did the stock get 100, it got 110. My caution started coming in at 109.28, which is the 1.618 Fibonacci extension. I also don't like a few things that are coming out of Mark Zuckerberg. One is his focus is on his charity that he, all the media loves that. I don't want him focusing on charity. I want him focusing on his shareholders and building Facebook. Him and his wife, God bless him, they're doing a phenomenal thing for humanity, but that isn't the way the stock market game is played. I also don't like that he is taking a long paternity leave. That means to me that nothing new in that period of time is going to come out significantly in Facebook. So there's really no catalyst to launch the stock higher. If anything, right now it is doing, and it's really doing everything right. It's really consolidating some of that overheated, it's working off some of the excess. It ran a lot on Google numbers that did it the last time. It did the same thing here, consolidate, but then eventually it did have a hard break lower. That will be the opportunity if the thing does break lower. You either want to buy it on momentum above the range of this consolidation or buy it at a Fibonacci retracement or a past reference breakout range for a buy. We got really close on... what was this day? 11/16 here. There was a pullback. We didn't quite get the 99.24. I said that it was a slingshot that needed to be fully cocked. It was only kind of partially baked there. We rallied back up into range, and we've just been chopping and using the 50-day since. It's held it a few times already. If you're long, you could use the 50-day, I guess. Above the 50 is bullish. Below the 50-day is... not as bullish. I would really start looking to reload kind of the big bet, so to speak, in this stock, somewhere between, I guess 99 you could nibble a bit, but I'd really be more interested around 96s and around 93s, and if you got some kind of like crazy flash crash, 86s, that's FANG, the F in FANG. Amazon, we all know that they are just Mac daddies over there. Jeff Bezos, congratulations. I think he's like the fourth richest man in the world right now. It's again, this one is doing a lot of things right here. It's consolidating. Its big 1.618 fib that I have for the last range was 660.64. It's basically been holding that. It had a couple of days with a look below. It looked like it was going to break down. It got kind of mid-channel, and now it's just consolidating. The stochastics are rolling over a little bit. I'll tell you this, though. The highs in the stock are poor. What I would love to see here is a liquidation break, ahead of their number, a liquidation break, get out all of these weak hands and these chasers, have it come to do the shake and bake, the down and then up. That would be the ideal setup. I don't know that we're going to get that. But I will say this, you can either buy Amazon again on, like I said, on that pullback, preferably to a gap fill would be fantastic, which actually is a 50% fib retracement, basically to the tick, or a move above this 684.82 range, and that would be the, I guess, after the consolidation, you could buy it on the momentum for that move. So those are the two scenarios. There's really nothing to do right now other than kind of watch the paint dry. The next one is the N in FANG, which is the Netflix, and that has a little bit of concern in it, and I'll tell you why. We had what I identified at the time, and again I took a lot of heat on this, was what it looked like a double topping pattern, and I said I thought we would see the 115, which we did. We got the bounce. Now, off a bit of a lower high, we are now back down there. It bounced again. If you snap 115 now on the third try, I think it's going to be a free fall down to 110, maybe 105, maybe even the 103.88. I do believe that this stock would set up well down there, at least for a bounce, because there's a channel low there, and I believe that even for like a day trade, right or right out, that would work. This is also going to sound familiar here. We're right on a 50-day moving average and 115. That's a very powerful number. So if you want to be long against the 115s. Any snap of that, you might want to do the GTFO, and that means the get the F out. And the last one of that cohort is Google. Also doing a really nice consolidation job. It was getting a little bit sporty. up against the, getting close to the channel high. We are just consolidating. Anything over 752.05, which was the gap range high of day, is bullish. Again, another one, I hate to be a broken record here, but the 50 MA is key. It's almost back up to there. It had a bit of a false breakdown of range. It held the 50, and now it is, it rallied. So I guess you could be long versus that 50-day moving average. And conversely, all of these, if they snap the 50s, right out for a short. Ideally, again, my best scenario would be for this one to do the shake and bake. I would love to see it come back down, maybe fill that gap, and then we reset and do it all over again for a move back up. So that's the story with that. The honorary FANG is Apple. Now, we have a little bit of a dilemma with the Apple. It's starting to look like a really big rounded top in the stock. The stochastics are first getting bombed out here, I'll tell you that. One of the bars is below the lower, one of the waves is below the lower bar, which is good. The second is not, so it's first getting oversold. The bad news is that we broke the 109 area, which was really key support, and we also kind of looked, I guess it was sort of a look below and fail below 107, although 107 did really kind of hold. You had, I think, one day closed below there. Let me see this. The close here, yeah, you had one day, and then the next day, yeah, one day closed below, and then you rallied back up. So we are now retesting the backside of an old up channel. The last time we looked below there was that move to 92, which was in the flash crash day, but the close of that bar, the body, was still above the trend. Now we have closed bars below the trend. We've now closed one day, 2 days, 3 days, now 4 days below the trend. Today was the rally to retest there. So I think where the rubber is going to meet the road here now at this 109 to 110 area. If Apple fails there again, we're probably going to come back down and maybe see the next rung of the 103s, maybe even the 100s. I would love to see this do the shake and bake also. It's down a good amount. We know the stochastics are getting bombed. I would love to see this thing into like free fall into their earnings to set up for a long again. If it rallies ahead of time, if we break the downtrend, you probably can play it long up to earnings, but then maybe kind of GTFO. So that's Apple. Let me get into some of these other ones that you guys mentioned. First, let's just start with the top of the key with Disney. Actually, someone had mentioned Baba. Let's talk about Baba. Baba is doing a really nice consolidation job. Live broadcast, I have appliances buzzing, and I don't get commercial breaks, so I have to drink a little bit of water. We have a consolidation in Baba. I think it's looking to me like it wants to resolve higher. I will tell you this is like the biggest tease, this stock. At least it was last year. Anytime it looked like it was going to break out, it would like have a false breakout and then just completely give it back and then some. Also with the breakdowns. Maybe this is not your grandfather's Baba. We are now making higher lows, so I would say a break of the 86.42 probably gets you a move up to the 89, which is sort of the end of this distribution. If you get up there, you're probably going to test 100 again. I think at some point this stock is destined to see 100, but let's kind of wait for it. We don't like to jump the gun. A lot of people who have jumped the gun with IBB have paid severely for that with the kind of head fakes in there. So if you're kind of new to the party with this one, 82.81 would be a key point. You want to be a little cautious. If you start losing 82.03 or let's say 82s, you want to maybe get out because that's getting a little bit iffy. If you lose 77, it's it's sort of going to be lights out for this stock in my view, because you'd be below this distribution and you'd now have multiple distributions of price still above you, not only the ones from the prior time, although they seem to be the ones maybe being made whole here, but you'd have this distribution as well. Disney, we all know Star Wars was a huge success. I'm going to be watching that. I I think on the 24th I'm going to see that. It's going to be my Christmas Eve movie. This was just sell the news. They basically dumped, they filled the gap, and now they're dumping again. The ideal scenario again for this would be just keep dumping into the numbers. We know they had a great Star Wars, so the numbers should be pretty good. What's plaguing them and dogging them, and what's going to be a problem for a while, although I got to think that their theme parks are maybe doing all right because the weather has been so warm. I'm not sure how that's going to play out, but we know that they're having problems with their ESPN subscriber growth. I don't see that changing anytime soon. I'm cautious on Disney here. You know, you had a bit of a lower high after a gap fill, and now it's coming down. I like put ratios in this. I don't think it's going to be complete free fall here, but it would not shock me to see it retest close to that 95. You have some reference lows from this run at 97.77, and then the pullback low after the kind of the flash crash, which got you to 90, was 95. It would not shock me to see that. I like put ratios to play for that kind of a move. Someone asked me about Goldman Sachs. All right, so Fed raised rates, the ideal scenario here, and Goldman is still in a bit of a downtrend. I don't love these. I'm going to go out on a limb here and explain that I don't like these financials for a few reasons. One, and the first and foremost, is they have been regulated. They have been neutered. Their earnings profile is not what it once was before the financial crisis. Dodd-Frank has just destroyed these companies. And I think that if you want to look for companies that are going to benefit from this, you want to look at the payroll companies like the Paychecks or whatever, but even better still are the insurers like the MetLifes, the Travelers. These stocks will benefit. They will mint money. These are amazing businesses. The insurance business is like the greatest scam ever. But they will mint money, and they will have a lot. They will be the real beneficiaries from rate rises. I do realize that depository institutions will do better now that they are raising the amount of money that they're charging on their mortgages, but they're not paying out on deposits. I would still prefer the insurers over these banks. That said, I guess Wells Fargo and JP Morgan are kind of the best in show. I'm just looking at these charts, the Bank of America. They all look like they're kind of building pressure. They'll probably eventually have moves higher, but like I said, I think you'll get more bang for the buck in the insurers. So Chipotle, I had told you guys that I thought that the stock was going to go lower, but I noticed a trading pattern and I discussed this in a last video that I sold near dated puts I think it was last week. And as it rallied back close to the 580, I took them off, and I was debating rolling them to January. And I said that when in my youth, I would have done the roll because I was in a profitable position, and hey, why not? You have a bit of a win. But at that point, I wouldn't be playing for a volatility crush, and to play for an oversold condition, I would be playing more directionally, and I didn't want to do that because I was still longer term a little worried. 100 points later here, basically, the stock is down, basically in a straight line from when I made that decision. Talk about experience paying dividends. And I think one of the things that I do believe Chipotle probably can bounce a little more from here, but I do think that it may want to see that 472 and maybe 442 to correct back into really where the true supports are and the breakouts are. I would like to sell out of the money puts in that area. Chipotle isn't the most liquid of options. There's a bit of a wide spread between the bid and the ask. So I would do it a little bit small and just be a little bit cautious, because if it goes badly against you, you might not be able to manage it as well as you could with, let's say, Apple or Google, which are more liquid. Anyway, today was the fifth day down. And you had guys who were yesterday was really the big breakdown. You finally broke 515. You had a bit of a flush, and now you have a lot of people who are jumping on that bandwagon. The stock is down $100 in 5 days straight, and today's the fifth day, and you're jumping on the short. If you were one of those people, you were really not in good trade location. You want to short stocks, and I know I've been promising to do this. a video on how to short sell, but you want to, first of all, the horizontal breakdown is one of the hardest ones to play for. Really what I like to do is either have a good, like to see the breakdown, some type of a throwback, and then short it there for the kind of like you get the move, the counter move, and then the resumption of the original trend. That's the easier way to play it. Or to see it come down, have a bit of a weak bounce, and then jump on it. You kind of play it that way. You don't first play it the 5th day down. That is amateur night. Anyway, the stock, obviously we know the story. They're having problems with their burritos, with E. coli. This will probably take a couple of quarters to play out. The ideal scenario here, believe it or not, would be for it to rally into the print and then play it short for the print for some type of a disappointment on the earnings. If they dump it too hard into the earnings, like if this thing just went down like every day into the earnings, they'll probably say something that'll catch shorts. So it's going to be a kind of a Costanza play to do the opposite, in my view. Someone asked me about SunEdison. I know David Tepper is having some beef with them. He bought one of their derivatives, and they're trying to unload their assets off into one of these like kind of shell corporations or whatever. They're whoever, they have deals with these companies where they unload their assets into. He's trying to undo some of those. I think they're trying to do it to survive, like they're going to kind of cream the derivatives to stay afloat. My guess is they'll probably be able to do something. I don't know. I don't know that it's a zero, but it may be. The story with this stock is it's either going to be a zero or it's probably going to go back up to like 11 or something. So you're either playing for a zero or a double. I don't know that it's going to be a zero. I mean, I think it's okay if you want to play it small. It's a lotto ticket though. Problem is the debt there. Someone asked about Twitter. Alrighty, so Twitter, it looks, believe it or not, like a bit of a head and shoulders. It sort of it broke down. Now it looks like it may be trying to do some type of a check back. In my view, anything below 23 half-ish is still vulnerable to lower. We'll have to see how that plays out. They need to show growth. They still have a growth multiple. It's a 12. I think the market cap, I have to check, is probably still like $12 billion. I mean, I don't know a lot of companies, other than maybe Apple with that kind of money on hand. I just don't see people throwing in for that. The stock, this is going to be another one of those. It's either going to get cut in half and see $9, or it's going to go back up to 45, 46. I think it's had a lot of tax loss selling. It's a great property. I think they're going to figure something out with this eventually, but I don't know that it's not going to come from $9. So if you want to be in it, a little bit, sort of not a lot, just a little bit, but all you need is a little bit. That's the story with that. Ford, someone asked about that. This is honestly not in my core competence of stocks I follow regularly. I kind of like to follow stocks that I think that I'm interested in. My problem with U.S. automakers is they build crappy cars. And, the Germans have been eating their lunch and the Japanese have been eating their lunch for years, although now with oil lower, the SUVs are going to start selling again, so that might be good. My fear is that they've reached peak autos. I know CarMax got slammed. That's KMX. They got slammed the other day. They're almost at a 78.6, although they're rallying from a recent range. I've been actually looking to get into that down in like the lower mid 40s and a retrace of that move. Also, it's a primary trend line. We'll have to see how that plays out. But my fear is peak autos. If the Fed's going to start raising rates, that's not good for auto sales. So you're kind of in the crosshairs of the Fed there a little bit. Nike, victim of their own success. The Jordan brand is doing phenomenally. I have a couple of pairs of those. They're a little bit too expensive in my view, but hey, whatever. People are buying them. Today was really ugly price action. It made a new high. It reversed. It engulfed multiple days worth of trade. I will say this though. It did hold the channel low from the pullback. If you draw a channel from the pullback low after the flash crash, it held that low today almost to the tick. It's also the end of a volume distribution. I'll show this in the Sunday video so you can see it more clearly. I just believe the stock is going to need to cool off a little bit. You'll probably get some kind of a bounce back into today's range because it was just so many points that it sold off, and probably people don't realize the end is here with these. It's just going to take some time to chop through a lot of the supply. I think that I mentioned in a tweet last night that the rally was a bit lame. The Wall Street is always fighting the last battle, and I think the fear here was Skechers. They had the report, they got the pop and the volume they needed, and people sold when they could ahead of the split. I think that's just, again, locking in gains. This has been a huge winner. There are not that many ones this year. This was a lock-in ahead of the split, pre-Sketcher fear, and also lock-in for the year. That's just all that Nike was. I would love to see this stock pull back to somewhere between like 114.79 and 117.72. That was like the breakout range. It's also a gap fill. I think that would set up for a great right or right out long. It's also where another volume distribution starts to begin, and I think there have been a lot of people that have missed this who would be interested there. We'll have to see. This could bounce back. This could just be an aberration, although I do think it's going to spend at least a couple of days, maybe a couple of weeks, just kind of catching its breath, so to speak. Let's get into the meat of it, and we could end here on SPY. All right, so this is what happened with SPY. This is going to probably be a little bit more useful for you to see on Sunday, but I'll give it a little bit of a tease here. You basically had almost a triple bottom. You right at the top of the bear flag, which was basically 99.84. I think you had a lot of people chasing, that day, first of all, you had a big move on the Fed day. That was the 12.16, the 12.17. It reversed. I think a lot of people got short in the hole. That was sort of like a panic. They were rewarded. Overnight inventory was short, and the next day was a gap and go lower. I think tons of people puked, piled on, and then, of course, they were wrong with the getting, I guess, short in the hole late, and you've got a bit of a rally back. I've been saying for a while, and I never wavered off of this, that we were going to look something like the period of time from last year, from last November to February, where we had this like constant ping-ponging up and down in range, and it's looking like we're doing that. The problem with that is that this is starting to look a lot like symmetry in the market, particularly where the flash crash low ended, the middle. This is also starting to look a lot like Apple, that big rounded top. That's, tops, people think, you hit one point and then it's just, down straight forever. It doesn't really work like that. My fear, and I had mentioned this, was that we were going to get the 1.618 Fibonacci extension, and we did. We got that on 521, and I mentioned that this was the point to start selling. I took a lot of criticism, and you know what? I'll tell you, if you did sell then, you missed a ton of volatility. You locked in the exact top. If you did that, my hat's off to you. And I can't wait for this broadcast to end because this is starting to itch. Anyway, the move here, we have the stochastics are not bombed out yet. There is room to go. The issue here, though, is that I think in the SPX and in the ES we got to the downtrend line. We did not fully get there in SPY. I like to talk in SPY terms, so let's talk in SPY terms. Let's not BS each other here. 199.84 held. We got back up to 201.90. We are back above there now. This is all very short squeeze looking. If you look at these profiles, you look at the volume, you look at the jerky way the market is going, it's the exact opposite of the puke, the panic. Now you've got the panic up. Anyway, anything above the 201.90 puts you kind of back into range. Really, I said that if we lost 197.86, I would start getting really bearish on the market. We didn't. We're back above the 201.90. We are now back above 204.12, which is really key because that's the kind of the gateway, the vestibule for the upper distribution, that band. I said that if we are above 204.12, that's good. We could see the 206.76, which is the kind of entrance into the bigger meat of that distribution, and also the 207.84. That's a key level. And then, of course, there's the 208.97, and then we go to 210 and 211. Anyway, I do believe that we're right under the 50 MA, right under the 200 MA, right under the 50 MA. You'll probably get some people who try to short that for some type of a responsive sale. It would be great if it coincided with the 206.76 when we got there. That would also be could be potentially where the downtrend is if it doesn't happen tomorrow. Maybe tomorrow's an inside day and then like Monday or Tuesday we get it. That would be a good right out short for me. However, if we get through there, there's not that much more time in the rest of the year. You've got a big chase for performance, and it's very possible we do see the 210, 211 again. We'll have to see how this plays out. But if we lose 204.12, that's a GTFO and a big penalty because this today would be like a look above and sort of a fail. We do have now a gap to fill below there. That gap here would be 203.5. So you got to be a little careful with that. If you start, I would say you could use today's low. If you start losing that, I'd say we're going to see the 204.12, and I really don't know that it's going to hold again. So just be a little bit cautious there. But the bulls have repaired a lot of the damage. Now they kind of have to just prove it that they're going to break the downtrend. The problem, again, is that we have a lot of supply above us. That 207 looms large, the 210, 211, you just have these big strikes that people are going to look to sell, in my view. So the market has a lot of supply to chop through. Just stick to the levels. Forget what the TV people tell you. Just stick to the levels that they never lie. Anyhow, that's my story. I'm sticking to it. Happy holidays. If you came in later, you want to see this again, I will post this on my YouTube channel. That's Justin Pulitzer Trades. Be sure to follow my new Instagram account. That's also Justin Pulitzer Trades, where I post the 15-second videos with what the market is keying off of that particular day. I think you will find that very interesting and insightful. It doesn't take very long, and it's good quality material. And also follow me on Twitter. My handle is @JustinPulitzer. Anyhow, happy holidays. I will, of course, be posting a weekend review on Sunday. And happy holidays and cheers.